Our favorite sector going forward, ag stocks. Food prices are moving higher. As food prices head higher, so do farm profits. By the middle of 2010, it has become apparent that for the 8th time in the past 12 years, grain production will fall short of consumption and the world will have to draw down its stockpiles. This was presented by Potash speaking at a conference. We actually have the slides, and we'll probably put those into some trade of the day or something, but they put on a presentation, and when they did this, in fact, this is a big part of our research, and around the time that we started buying Mosaic and got really bullish on the fertilizer stocks, on agricultural stocks, and so forth. In 2011, Potash estimates that it will take a 5% increase in grain production to keep pace with consumption. That will be basically an impossible task. Grain production has grown by only an average of 2% a year in the past few decades. Without a record increase in production, we'll fall short, and obviously if there's a shortage, that means prices are going higher. That type of production necessity causes higher grain and food prices. There's demand. It's simple supply and demand. They need more grains. They need more food. Great for farmers. Great for the companies that sell the products. Bad for consumers, especially poor consumers. Who's hit hardest? Really, it's the emerging markets. In China, in India, they're seeing huge inflation in food prices. In fact, China even went so far as to set caps on what certain foods could be priced at and so forth. You can see there's a lot of demand. By November 2010, the year-to-year increase in the global food price index was 22%. That means long agriculture. Now, you could play it through stocks like Deere. You don't have to go pile in head first. There will still be corrections. Obviously, any dip to the 50-day moving average has been tremendous for this type of stock. You can play it through fertilizers. We were patient, and in the middle of this month, it had a nice pattern, accelerated to the upside. We bought here at around 66 in Mosaic, and I think we're up 14% or 15% in 10 days, something like that. So do you have to chase it here? Well, of course not. There will always be peaks and valleys. Don't feel ever like the market's leaving without you. Don't panic your way into anything, but look selectively at this space if what we're talking about makes sense to you going forward. Let's now look at markets as a whole. Kind of a fun little exercise here. The market average is 9% historically. That's the average positive return of the stock market per year. So that might surprise some people, especially if you've been fully invested for the past 10 years and not made anything. But that's history. One standard deviation should contain the data 66% of the time. So what's one standard deviation of the market average return? Well, it's 15%. That tells us that 66% of the time the market's annual return will fall between -6% or positive 24% for the year. That's 66% of all data. 95% of the time, the market's annual return will fall within two standard deviations. So 15% taken off of each side again. That means between -21 and positive 39%, 95% of the time. 99.7% of the time, the market's annual return should fall within three standard deviations, or between -36 to positive 54. So it gives you an idea of where markets are at historically, what type of expected return the market will have per year. What are your predictions? In the registration, we asked you what the S&P performance would be in 2011. We had a huge response. You might be surprised at how many people actually responded. It's awesome. Your predictions, and this is a huge sample size, 4% said between positive 24 to positive 39%. Those are the optimists, okay? Pollyanna there. 9% to 24%, 52% fell in that category. So the majority said, hey, we're going to be up for the year, between 9 to 24%. Little less than that, 37% said between -6 and +9. And then finally, 4% said between -21 and -6%. That's still within 2 standard deviations. And then the outliers, those that thought we were going to get to 3 standard deviations and so forth, 3% said we're going to be above 39% positive or below 21% negative. My gut feeling is they were probably expecting us to fall by more than 21% for the year. So this gives you a sample size of what everyone attending here, the averages are for your expectations. Now, we happen to fall kind of in one of those categories, and here's where we talk about what we expect in the year ahead. 2004 was much like 2010. However, a lot more volatility. As we said, we expected to fall to 1020. We did that in a hurry. We had hit there, just about a month and a half after being at 1230. So the markets fell, S&P fell 200 points. That's almost 20%, call it 17% of its value in a month and a half. We've rallied from the lows in August in just a couple of months. Look at the extreme rally we've been in. So the answer is, number one, increased volatility. Expect more movement. Doesn't mean that there's going to be more upside or downside as a whole. It means you're going to get trends in both directions, and this is good for a trader, not necessarily for, if you're looking for slow, steady, profitable moves upward in the market. It's not necessarily the case. But 2010 was choppy, like 2004, year coming out of a recession and everything we talked about. 2011 will frankly probably follow the 2005 script. Choppy year, some volatility. If that's the amount of movement we had in 2005, then I would draw up 2011 to be more violent, more volatile, but a similar type of dynamic. And ultimately, our price target for the S&P 500 is, we think, more bumps in the road, more volatility. Expect to see debt concerns come out in Europe. Expect to see China slowing inflation. China's a concern right now. China has rolled over. The U.S. is still at new highs. We see more economic uncertainty, global chaos and wars. Pay attention to North Korea. A little bit of craziness going on over there. We expect to have at least 2 10% corrections and 2 sharp 10% rallies mixed in. Somewhat of a choppy year. Should be a great year for traders. Not necessarily that fun for buy and hold. Our price target is, well, kind of a boring 1320 on the S&P, up a little bit by the time the year's done. And that's kind of that's throwing it out there like the weatherman giving a 1-year prediction. It's an educated estimate of what we expect, but more importantly, look at the markets by June of next year. Frankly, by March, we might have a completely different view. But it gives you some expectation. We think the markets will ultimately move higher. There could be a good-sized sharp rally and then a significant decline, and you get the idea. Plenty of volatility mixed in. Let's look at trading strategies for 2011. Here's our picks and pans. Sector-wise, we like materials still, most specifically those related to agriculture. We like industrials. We like Russia, believe it or not. Russia has a lot of exposure to energy and some of the related assets there. They're an emerging market. We've tried to play Russia through a couple of plays here in the last 2 months. We first bought VimpelCom and made 7%. Then we bought it again and lost 5%. But we've played that a little bit in the last couple of months. We expect it to outperform. Industry-wise, agriculture, fertilizers, okay? MOO is basically a basket. It's an ETF if you wanted to play that. But you've got Deere. Syngenta is a seed company. Still like natural resources to a certain, our view is really actually more geared up towards, timber and some various assets there. Security technology companies. Some of the tech space we're not in love with. Some of it we think is looking fantastic. We've got a position in Checkpoint. Steel companies look strong. Oil exploration could really rebound. On the pan side, well, we're going back to the well. Is this the year that the consumer gets hit a bit? We think financials will still underperform. That doesn't mean that we're expecting Armageddon. If Armageddon's going to hit, home builders probably have the most potential for downside. Precious metals, we believe, are going to have an underperforming year, and China will have an underperforming year. So if you're playing the emerging markets, may surprise some, but not as bullish on China and a lot more bullish on Russia for the next year. Industry-wise, airlines will be hit by rising oil prices, regional banks, consumer or commercial real estate, specialty retail, which we have a bear call spread in, travel and leisure. So similar type of approach to last year. Not that much has changed, but some differing views. Precious metals, not so bullish on. We liked technology last year. Don't like it as much going forward this year, at least in certain names. Oddly, we kind of like the old school technology where a lot of people hate that type of play. We love Microsoft. We talked about the dividend yield versus other assets. They're cash rich. You know what you're going to get with them. A lot of ways to make money, especially if you use options with them. So if you like the tech space, we like the security space, maybe even Symantec and so forth. Now, another thing that you can look at, fundamental criteria, make sure your sales and EPS growth is strong. You can use our GER scores for finding the top-rated companies. Interesting that Apple has taken a little step back. Apple was one of our top-rated GER companies for years in a row, multiple years. It was always in our top 20. Apple is no longer in the top 20. It's still strong, still B-rated. I wouldn't short it. But the point is, it actually has taken just a slight step back, and that all happened this year. Bull and bear meter, 3 bulls, so still strong, still expecting the stock to go higher, but just be mindful of that. That's that type of stock that a lot of people tend to buy and hold. So while it can go up, you're not seeing it perform. You're even seeing that. Look at the upside move that the market has had since August. Look at Apple over the last couple of months. Okay, it's not performing here like the market has. So be aware of that. Another thing that you can pay attention to before we wrap up, volatility. We talked about it last year. We're going to talk about it again. It's just measuring the implied volatility of the S&P. It's a good way to kind of measure how fearful or greedy the market participants are. If you have a high VIX, that corresponds with a more volatile market. Therefore, options are costly, but it can be a timing device. Low VIX corresponds with a complacent market, lower volatility or less fear, and less expensive options. You can use the volatility to point to market direction at the extremes, and that's the important point. Don't use it every day, but when you get to an extreme. Now, you should not use it for what, basically, I'll explain more. Let me tell you the saying. When the VIX is high, it's time to buy. That means buy stocks. Don't buy options, because options are expensive when the VIX is really high. But it means to be bullish. Look to be bullish when others are fearful. So high VIX creates buying opportunities. When the VIX is low, look out below. Meaning, look to sell stocks into complacency, and when people get too greedy, you want to sell into that euphoria. So, doesn't mean that you want to do basically you want to do the opposite with options. You try to buy options when the VIX is down, you try to sell them when the VIX is really high. Better to be a buyer of stocks when there's too much fear, when the VIX is high. A seller of stocks when there's too much complacency or the VIX is low. What strategies you would do with options are reversed, and that's an important point.